Well, hello. How's everybody doing so far? Enjoying the conference? All right. Well, we are here to talk today about PCI DSS compliance and payment facilitation. Just by a show of hands, because I love to kind of get a gauge of the audience here. How many people are even familiar with what payment facilitation is, or PayFacs? Right? Well, good. We've got quite a bit. But I also see a lot of people that didn't raise their hand. That may be because if you raise your hand, you get called on. And it may be because you may not know what PayFacs are or don't feel comfortable really explaining those to a colleague. So Helen and I are here to talk that through with you a little bit today, specific within the realm of PCI DSS.
Thank you, Sam. Welcome, everyone. So I'm Helen, and I'm a team lead in the Global Scheme Compliance team at Adyen, overseeing, amongst other things, the PCI standards globally. I have first-hand experience in managing risk from the acquirer and the merchant perspective with regards to security and compliance programs. Over to you, Sam.
And I'm Sam Pfanstiel. I'm a principal analyst at Toast. Now, Toast is a payment facilitator, right? And we provide payment processing through our cloud points of sale for hospitality and retail submerchants in North America, Europe, and now Australia. I run our PCI compliance program, including overseeing controls for meeting compliance against PCI DSS, PCI Software Security Framework, Secure Software, and Secure Software Lifecycle. We do PCI PIN, PTS POI now for our latest PTS-approved POI device, the Toast Go 3. I do work closely with our acquiring partners, like Adyen, and our merchant risk teams to support our sub-merchant compliance through our attestations, responsibility matrices, guidance documentation, and compliance reporting. Now, I'll provide a little bit of an overview for today's talk. First, we're going to just give you a little bit of an overview of what a PayFac is, what the timeline was, and how it's evolved in this ecosystem for payment facilitation. Then we'll talk about entities and roles. It's important to understand that in the PayFac architecture, there are different entities involved, and they do take on a slightly different responsibility. So we'll talk about PayFacs, marketplaces, acquirers, of course, brands, and the PCI SSC's role. And finally, we'll bring it home with PCI strategies for PayFacs, including responsibilities, reporting, and best practices. Helen?
Thank you, Sam. So starting with the PayFac overview. So why is this topic timely and important? So firstly, the rapid global expansion of platforms, SaaS providers, and marketplaces has fueled the PayFac model, making it one of the fastest growing business models in the payment industry. This model significantly lowers the barrier to entry for small merchants, but also shifts a huge compliance and security responsibility to the PayFac. In the PayFac model, the PayFac, not the acquiring bank, is typically responsible for ensuring PCI DSS compliance of their own systems and infrastructure and the submerchants they onboard, depending on how payment data is handled, of course. Data breaches, fraud, or non-compliance at either the submerchant or the PayFac level can lead to fines, penalties, reputational damage, and even removal from the card networks. So to back this up with some stats, as you can see, in 2019, there were 966 payment facilitators globally, increasing to 2,108 by 2024. And it's predicted that in 2025, this will grow to 2,380 PayFacs globally. Between 2018 and 2019, the gross payment volume processed by PayFacs worldwide increased by 32% in just 1 year. And this is expected to reach over $4 trillion USD by 2025. Such growth can be explained by an increased number of payment facilitators and an expansion of current payment facilitators' customer bases. As the PayFac model continues to power the global shift to embedded payments, ensuring strong PCI compliance is no longer a checkbox activity. It's a business-critical requirement. In this session, as Sam was mentioning, we'll explore how to navigate the master merchant and sub-merchant relationship and how acquiring banks and card networks cooperate with PayFacs to mitigate risk, achieve compliance, and deliver agile, frictionless payments. Starting with the evolution of the PayFac model. So Visa and MasterCard introduced the PayFac model into their rules to ensure that platforms could act as merchant aggregators within a regulated, risk-controlled framework. So what is a payment facilitator? A payment facilitator acts as a middle layer between sub-merchants and acquiring banks, handling the technical, financial, and compliance complexities involved in payment processing. This enables faster onboarding, lower friction, and easier access to electronic payments for small and medium-sized businesses. This allows small businesses and individual sellers to accept payments quickly without going through a traditional merchant account setup. In the traditional setup, merchants need to go through a direct relationship with an acquiring bank to accept card payments. This model works well for large enterprise merchants, but can introduce friction for small merchants. Some key characteristics of this is lengthy onboarding, high compliance burden, and complex integration. With the rise of online platforms, a new need emerged, allowing many small sellers to accept payments quickly within a platform. This led to the development of the PayFac model. The concept of PayFac has undergone significant evolution since its inception, driven by the need for more efficient and accessible payment processing solutions. So who are the entities and what roles do they play in the PayFac relationship? So here you can see a PayFac ecosystem relationship diagram, and I'm going to walk you through the various different players in this diagram. Starting with the cardholder, otherwise known as the shopper. This is the individual who uses a credit or a debit card or another form of payment to purchase goods or services from the submerchant. The shopper has a relationship with the submerchant as they make a purchase from the submerchant. The submerchant is the actual business, for instance, a small shop that sells directly to the cardholder. They operate under the PayFac's umbrella, but they don't hold a direct contract with the acquiring bank. The submerchant holds a relationship with the payment facilitator. The transaction is processed under the PayFac's master account. As mentioned, the PayFac is the entity that holds a master merchant account with the acquiring bank. They onboard, they underwrite, and they manage compliance for all of the submerchants under its portfolio. They route the cardholder's payments through their systems. The PayFac holds the relationship with the acquiring bank. The PayFac submits the aggregated transactions to the acquiring bank. The acquirer is the financial institution that processes card payments on behalf of the PayFac and its submerchants. And the acquirer subsequently holds the relationship with the card networks, who holds the relationship with the issuing bank. The acquiring bank routes the payment request through the networks to the issuing bank for approval. And finally, settlement. The funds flow back from the issuing bank through the card networks to the acquiring bank. The acquirer can settle directly to the submerchant or via the PayFac to the submerchant, depending on licensing.
Right, and that dependency on licensing is important because not all PayFacs are the same, and we'll be going into that a little bit more detail in just a moment. As Helen mentioned, we do now have multiple merchants in this equation, right? So she mentioned a couple of terms, master merchant and submerchant. And spoiler, there's actually about a dozen other merchant-type language terms that I've seen found in various payment facilitation documents, agreements that are out there. And here's the real important point. Whether you are calling yourself a master merchant, a sub-merchant, I've seen platform merchants, we talk about that a little bit later, but you have the original merchant or the sponsoring merchant. These terms mean exactly what they mean in the context of the agreements that are held between the bodies, whether it be the PayFac and the acquirer, or the PayFac directly with the card brands, as we'll talk about registration. These terms don't have, unfortunately, a globally accepted meaning. So now, it's not the goal of this presentation, again, to define these terms, and I'm not going to use this discussion to even try to disambiguate the usage of those roles and responsibilities within each of those blanket terms, because, as I said, frankly, this has not been well defined. However, the knowledge that there are multiple merchants in this ecosystem is super important, and it's one of the big key takeaways we wanted to make sure that this community is aware of. I'll just point out in this case, and we'll talk about best practices in a moment, that identifying responsibilities in those agreements, as I mentioned, is the most important factor. Similarly, PayFacs and acquirers must identify their responsibilities. So let's talk about PCI DSS. PCI DSS 12.8.5 and 12.9.2 are where you find the requirements in DSS for those individuals, whether you're a service provider or a merchant, to define your relationship with each other in terms of specific PCI DSS responsibilities. The role of a responsibility matrix or responsibility guides or other documentation, sometimes called a shared responsibility matrix, is super important. And without that, there is no clarification or clarity in that delegation of responsibilities. All right, so let's talk about service providers. Speaking anecdotally, for Toast, when we submit when we undergo our report on compliance, we do so under the service provider ROC. That's important. All of the service provider additional security requirements we must meet as a function of that role, because we are, as the PCI glossary defines, a service provider may be, a merchant may be a service provider if they receive payments on behalf of another merchant. And we do that because our sub-merchants are other merchants. However, ultimately, whether you must submit on a service provider ROC or on a merchant ROC is really something that you must discuss with your acquirer and the brands to ensure that you're meeting all contractual obligations. So where it's, with respect to PCI SSC, now, we often hear in these meetings that check with your compliance accepting entity, and that's exactly as I just mentioned. But there are some programs within PCI SSC's remit that involve the definition of merchants. So one of those is the point-to-point encryption program. We have merchants as solution providers, also known as merchant managed solutions. Again, the term merchant being used in a context that requires it to be well understood and defined by the P2PE assessor and all entities that are attesting compliance. So where there may be opportunity for improvement as the PayFac model becomes better known is to ensure that those definitions are clearer so that all P2PE assessors understand what a merchant may or may not do and who is the merchant in, for instance, if the PayFac itself is providing the solution.
Now, you may have also heard of the term marketplaces. Marketplaces may facilitate payments between buyers and multiple sellers. The marketplace itself is typically the merchant of record for the transaction, and the sellers, or the third parties, they do not have a direct merchant relationship with the acquirer. The platform owns and operates the e-commerce platform. The platform accepts payments on behalf of the sellers, and the sellers are not registered merchants with the acquiring bank or card networks. While marketplaces and payment facilitators both serve as intermediaries between buyers and sellers, they're fundamentally different in terms of structure, regulation, and responsibility, especially in the context of payments and compliance. For instance, with regards to compliance and risk, marketplaces may reduce their burden by outsourcing certain compliance obligations to processors or acquirers, whereas payment facilitators, they own the compliance stack. They're responsible for PCI DSS, KYC, AML, chargeback monitoring, and sub-merchant oversight. With regards to PCI scope, understanding and managing PCI scope is especially important for payment facilitators and their sub-merchants, since both can be exposed to different levels of risk depending on their setup. The PayFac is responsible for providing a PCI-compliant infrastructure and for educating and supporting submerchants.
So let's talk through a few strategies, right? So as a PayFac, and I'll continue to use the term PayFac in this context, marketplaces are like a cousin to PayFacs, a lot of similarities as Helen said, but we'll just continue to talk about PayFacs specifically. When we talk about best practices and responsibilities, which again is where this boils down, we really must understand how these relationships are established. So we start at the PCI SSC, which is where we are today, right? The PCI SSC is responsible to manage those standards, those programs, to provide global guidance related to securing cardholder data. That those tools and training, whether it be PCI DSS or the SAQs or programs like P2PE and SSF, these are frameworks within which our relationships operate. Then you have the card networks. They set the rules and requirements for participants in that payment ecosystem, and that includes PayFacs. So as I mentioned a moment ago, PayFacs are required to register through our sponsoring acquirer with the card brands. This requirement ensures that we are accountable both to our acquirers as well as the stakeholders in the sponsor schemes. So we now, and the brands, of course, enforce that PCI compliance, and they monitor PayFac activities to ensure that we are aligned with the card network's risk and compliance. Now, our acquiring partners, ultimately, they're liable to the card networks for that risk and compliance. For us, so they're responsible for for us as PayFacs and our submerchants as a part of that portfolio. We, as the sometimes called master merchants. Now, I say that again, that's a term that's sometimes used. Sometimes there are other terms that are used, but those PayFacs are, in this model, responsible to take on that role of the aggregator. We onboard and manage those multiple submerchants. We do the underwriting, KYC, and onboarding, and then we perform payment processing. As we mentioned earlier, not all settlement goes through PayFacs. Sometimes PayFacs can be out of the settlement flow. So that's an important note. Now, marketplaces, again, another type of master merchant, but then you have those sub-merchants, and these, importantly, need to follow the leader. And so since their relationship is with the PayFac, the sub-merchants are responsible to attest their compliance or work with their PayFac to use the approved tools, use the payment processing platforms, and again, follow the guidance that their PayFac provides them to attain PCI DSS compliance. Now again, best practices. So these are some of the learnings that Helen and I have had through our relationship, and we wish to share those with you today. Some of the things you want to start with if you're considering the PayFac model is look at PCI from the outset in that relationship. This starts with the engagement with your acquiring partners. That contractual process and due diligence is crucial for ensuring that you have a level-set understanding of those responsibilities and ensuring, of course, that both the PayFac and acquirer are compliant. Then you have the engagement on the day-to-day basis. This is where we're onboarding and integrating our merchants into our platform, our sub-merchants, as it were. And the risk management process that includes PCI DSS, as we discussed earlier, 12.9.2, 12.8.5, all of 12.8 when you're a merchant, a sub-merchant that's engaging with your payment facilitator to ensure that you understand what responsibilities they're going to take on your behalf. It should be clearly documented. It shouldn't just say, I agree to be PCI compliant. Those agreements should be clear that you're receiving some PCI DSS benefits from your acquiring partner, which in this case would be the PayFac and the PayFac with the acquirer. And finally, what does PCI reporting look like for sub-merchants? That PayFac needs to, part of one of the roles that many of the acquirers give to their PayFac partners is to keep track of transaction processing, attribute or inform those sub-merchants of their merchant level based on the brand's guidance. And then the PayFac would report the compliance and levels and aggregate data to the acquirer so they can manage risk at the acquiring level. And that's what we call a 360-degree PCI compliance best practice model.
So as Sam already mentioned, the PayFac and the acquirer need to work closely together. So how do you win together? Firstly, collaborate closely. So really align on perspectives and risk mitigation. Make sure that the shared responsibility is properly defined and that it doesn't become, like I mentioned previously, a box-ticking exercise. Scope the impact. Toast, for instance, as a closed ecosystem, gives them more control over the various payment implementation, devices, and acceptance channels. Furthermore, by providing or enforcing the use of specific tools, a PayFac can, for instance, speed up merchant onboarding and also simplify the process for confirming SAQ eligibility and submitting documentation. Looking ahead, so as we close, it's important to stress that the PayFac model is not static. It was designed and adapting, and it's doing just that. It's rapidly evolving in response to shifts in consumer behavior, technological innovation, and regulatory frameworks. It's being influenced and also influencing the PCI standards, whilst we also see the support for new payment models. Consumer expectations, they're accelerating the change too. We're seeing a massive uptake in digital wallets, contactless payments, buy now, pay later, and real-time payments. All of this puts pressure on platforms to offer faster, more transparent, and omni-channel payment experiences. Lastly, many providers may focus on expanding their services globally and addressing the complexities of cross-border payments and local regulations. PayFacs are a foundational layer in the future of the payments infrastructure. Staying agile, compliant, and customer-centric will define long-term success. Thank you.